Hey, what's up everyone? Let's talk taxes. I know, taxes aren't exactly the most exciting thing in the world. But what if I told you your small business might be missing out on thousands of dollars in tax deductions? That's right, thousands. Alright, let's kick things off with a big one. The home office deduction. If you use a dedicated space in your home exclusively and regularly for business, you can deduct a portion of your rent or mortgage interest, utilities, property taxes, and even home insurance. We're talking about expenses you're already paying, but now a portion of them becomes a write-off. The key here is exclusive and regular use. The IRS offers two methods for calculating your home office deduction: the simplified method and the regular method. The simplified method is, well, simpler, but the regular method might result in a larger deduction, especially if you have a larger home office. Do your research, keep meticulous records, and consider consulting with a tax professional to make sure you're maximizing your savings while staying on the right side of the IRS. Starting a business is exciting, but it can also be expensive. The good news is that the IRS offers a sweet deduction for those initial startup costs. We're talking about those expenses you incurred before your business officially launched. So, what exactly qualifies as a startup cost? Think about things like market research, advertising, legal fees, creating a website, even travel expenses related to setting up your business. The IRS allows you to deduct up to $5,000 in startup costs right off the bat, but only if your total startup costs are $50,000 or less. If your startup costs exceed $50,000, the deduction amount is reduced, and anything over $55,000 means no immediate deduction. The remaining costs are then amortized or deducted gradually over 15 years. Keep those receipts, invoices, and contracts organized so you can easily substantiate your expenses if the IRS comes knocking. Alright, let's talk about something that almost every small business owner can relate to: using your car for work. Whether you're driving to client meetings, picking up supplies, or making deliveries, those miles add up, and they can add up to some serious tax deductions. You have two options when it comes to deducting vehicle expenses: the standard mileage rate method or the actual expense method. The standard mileage rate method is pretty straightforward. You simply multiply your business miles driven by the IRS's standard mileage rate for the year. The actual expense method involves tracking all of your vehicle-related expenses, including gas, repairs, insurance, and depreciation. You need to track your mileage meticulously, distinguishing between business and personal use. A simple mileage log or a mileage tracking app can be your best friend here. Let's talk about retirement, because planning for the future is just as important as managing your finances today. Contributing to a retirement account can actually save you money on your taxes right now. There are a few different retirement plan options available to small businesses, such as SEP IRAs, Simple IRAs, and Solo 401(k)s. The beauty of these plans is that your contributions are often tax deductible, meaning you can reduce your taxable income in the present while building a nest egg for the future. So don't wait. Start planning for your future today. Your future self will thank you. As a small business owner, you're probably well aware that health insurance can be a major expense. But did you know that you can often deduct 100% of your health insurance premiums on your taxes, not just a portion? The deduction also applies to premiums you pay for your spouse and dependents, which can really add up to significant savings. And the best part is, you can claim this deduction even if you don't itemize your deductions on your tax return. So take advantage of this deduction to make sure you and your family have the coverage you need without breaking the bank. In the world of business, knowledge is power. The IRS recognizes that investing in your education and skills is essential for your business's growth. That's why they offer deductions for education and training expenses related to your current business. Think about it: attending industry conferences, taking professional development courses, even subscribing to trade publications. These are all investments in your business's future. It's important to make sure the education and training you're pursuing is directly related to your current business. So whether you're looking to expand your skill set, stay ahead of the curve in your industry, or simply improve your business acumen, don't overlook the valuable tax deductions available for education and training expenses. In today's digital age, getting the word out about your business is more important than ever. The good news is that the IRS allows you to deduct most, if not all, of your marketing and advertising expenses. We're talking about everything from online advertising campaigns and social media marketing to printing business cards and sponsoring local events. Make sure you have invoices, receipts, and contracts for all of your marketing and advertising expenses. Consider developing a comprehensive marketing plan for your business to track your marketing expenses throughout the year. Okay, let's face it, office supplies might not be the most glamorous part of running a business, but they're essential nonetheless. And believe it or not, those seemingly small expenses can actually add up to significant tax deductions over time. We're talking about everything from basic supplies like pens, paper, and printer ink to larger equipment purchases like computers, printers, and office furniture. For smaller, less expensive items, you can typically deduct the cost in the year you purchase them. For larger, more expensive items, like a new computer system, you'll likely need to depreciate the cost over a period of several years. Keep those receipts organized and categorized. Let's face it, running a business means dealing with clients, and sometimes, clients don't pay their invoices on time. It's an unfortunate reality of entrepreneurship, but the good news is that the IRS offers a potential tax break for those bad debts. The debt must be considered bona fide, meaning it was a legitimate debt incurred in the ordinary course of your business. You'll also need to have previously included the income related to the debt in your taxable income. Turning a loss into a tax advantage is always a smart business move. All right, let's wrap things up with something that feels good: charitable contributions. As a small business owner, you have a unique opportunity to make a difference in your community while also potentially reducing your tax bill. The IRS allows businesses to deduct charitable contributions made to qualified organizations. These organizations typically include nonprofit groups, religious institutions, and educational institutions. Keep in mind that there are limits on how much you can deduct for charitable contributions, typically a percentage of your adjusted gross income. So, whether you're passionate about a particular cause or simply want to give back to your community, don't underestimate the power of charitable contributions. So there you have it. Those are 10 commonly overlooked tax deductions that could potentially save your business thousands of dollars come tax time. Every business is unique, and there might be even more deductions specific to your industry and situation. That's why it's always a good idea to consult with a qualified tax professional, like the team at Pupilo Tax. Start planning now, keep those receipts organized, and consider booking a free consultation with Pupilo Tax to discuss your specific needs. We're here to help you keep more of your hard-earned money in your pocket.